Hello, I'm Irfan Mansoor and welcome to my channel. Today we are going to discuss a very important topic, that is GAAP, Generally Accepted Accounting Principle. And now, what are GAAP actually? GAAP are set of rules that define generally accepted accounting practices. It ensures consistency in reporting, means financial reporting and presentation of financial statements. The purpose is to ensure entity produces financial information that is useful to existing and potential users of the financial information in making decisions for or about the company. Why do we need GAAP? And what are the systems that exist? Actually, for accounting framework, it can be said that there are three sources by which we can have practices or best practices principles. Number one, that is GAAP, the generally accepted accounting practices or principles. Number two, every country has its own regulatory authority, such as in Pakistan we have SECP, Security Exchange Commission of Pakistan, and every country will have its own regulation. The second source for the accounting framework guidelines is the statute, is the regulator of accounting practices, that is Security Exchange Commission. And further, the third source, that is the globalization of accounting practices. That source is IAS and IFRS, means International Financial Reporting Standards and International Accounting Standards. Why do we need GAAP? In this situation where you have regulator, you have GAAP principles, and you have globalization practices of accounting, or a set of the globalized practices in accounting, that is IFRS, we need GAPs, and GAPs are very important even if you are using or following the guidance of International Financial Reporting Standards. Sometimes there is not a definitive guideline in the accounting standard that govern a specific situation. In such case, accounting conventions can be referred. And let's begin our first topic, our first accounting concept, our first principle of accounting, that is Doubleentry Concept. You should know that accounting is purely based on double entry system. Every transaction has two effects. For exchange of value, two parties are required, a giver and a receiver. Technically speaking, For every debit, there is a credit entry, or more than one debit has one or more than one credit, vice versa. Therefore, we can say that every debit must have a corresponding credit or must have some corresponding credits and vice versa. This is the only system of the modern accounts. Let's see the accounting equation mentioned below. Assets is equals to liabilities plus owner's equity. If you see resources assets is equals to when you add equity, definitely equity is the source that provide asset, means owner provides assets to the business is equity. When it is obtained, it is borrowed from outside the organization, it is a liability. There are two sources, liabilities and owner's equity, that provides assets or resource to use in the business. Hence, assets is equals to liabilities plus capital or owner's equity. And you can see the effects. Whenever an asset increases, it will have a debit effect, while liability or owner's equity capital increases, it will have a positive credit balance. While look at the credit side of the asset, decreasing of asset, definitely whenever asset decreases, it will decrease or it will result in a decrease of a liability or owner's equity. Then if assets decreases, definitely liability will decrease, because you will have to settle off the liability against assets, cash or anything valuable, that is your asset. And further, if assets decreases, for example, owners withdrawn its some of the amount from its capital, from his capital, then it would be decreasing in the capital. Assets decreases and it will have a credit effect, while owner's equity also decreases and it will have a debit effect. And you can fairly observe here that each transaction are leveling other transactions effect. We will discuss further in our lecture, new lecture, in detail, and see these principles. Accrual concept. One of the biggest role in accounting. There are two bases of accounting. One is cash basis and second, that is accrual basis. Cash basis accounting we are not going to discuss here. So far we are here discussing about accrual concept. Accrual concept basically governs the recognition criteria of expenses and revenue. Side by side, for expenses, that is prepayment, means an expense that has been paid but not yet expired, or an expense that has been incurred and not yet paid, or revenue that is earned but not received, or the revenue that is received, means the consideration has been received but not yet goods or services are provided. Let's see what the accrual concept says. Entities should record items of revenue and cost into the books of accounts in the period when they occur, when they incur. Note the point: an expense that has been incurred, not yet paid, the entity should record this as an expense. And for the because we are using double entry system, expense should be recorded, and payable means accrued expense should be realized into the balance sheet, and it shouldn't be delayed, means for the period for which these expenses or revenues are related should be disclosed, irrespectively whether cash or cash equivalent has been paid further or not. Let's talk what IAS 18 revenue, what it defines. IAS 18 outlines the accounting requirements for when to recognize revenue from the sale of goods, rendering of services, and for interest, royalties, and dividends. Revenue is measured at fair value of the consideration received from receivable and recognized when prescribed conditions are met. Generally, these conditions are the delivery of goods and acceptance of the goods, etc., which depends on the nature of the revenue. Definitely the recognition criteria, look, it is fairly connected with accrual concept here. It is probable that any future economic benefit associated with the item of revenue will flow to the entity, and the amount of revenue can be measured reliably. This is the addition of accrual concept, where accrual concept says when to realize or recognize items of expenses, income, liabilities, or an asset. Here, the recognition criteria is defined by IAS 18. While preparing financial accounts, means financial statements, it is really important to present the data on the consistency basis. Data should be comparable with alike data and comparable with the previous year data. Definitely, when we are preparing our financial accounts, we prepare comparatively past year and current year. It should be comparable. Items of balance sheet, profit and loss account, cash flow statement, equities, retained earning. It should be presented in a manner that is comparable to each other. Further, it should be consistent. Maybe there are some circumstances where an entity may change its consistent reporting, but under such circumstances, reasons, and the outcome of the change should be disclosed. Here, comparability and consistency principle is defined as all the transactions should be recorded in a single currency. Definitely, if we will use different currencies, the consistency will not be applied here. It would be wrong to record multiple currencies. Entities should be consistent in their disclosure in the financial statements. The same accounting method of recording transactions should be used by a company from period to period. I have already explained you the exception where company can change its reporting. Completeness and timelines. This is another important criteria while preparing financial statements, financial accounts. Incomplete information reduces not only the relevance from the financial statements, it also decreases the reliability of the financial statements, since user will be basing their decisions on the information which only presents a partial view of the affairs of the entity. Therefore, information must be complete in all material aspects. And further, timelines. Principle in this accounting refers to the need for accounting information to be presented to the users in time. If the data that is presented is not presented timely, it has no meaningful information for the user. The user in the time to fulfill their decision making needs correct and timely data. Matching concept. Matching concept basically states that revenue of a particular period should be matched against expenses of a particular period. After that, we will have the result of that period operations in form of profit or loss of the entity. Let's see what the definition says. Revenues of a period should be matched against expense of the same period. An approximation in the amount recorded for a financial statement item when there is no precise means of measurement. Estimates are based on management's judgment and specialized knowledge derived from past experience. Here we have many aspects to consider. First of all, revenue should be matched against expenses of the same period. Further, an approximation of the amount should be recorded into the financial statement when there is no precise means of measurement available. For example, construction contracts and government subsidies. These are the item that should be taken into the account. Further, estimates are based on management's judgment. For example, definitely we are doing here accounting on accrual basis. Then we must have sold goods and recorded and reported goods in form of receivable, means revenue against cash or cash equivalent has not been received. Here we got some problem. What sort of problem? These problems are that based on our past experience, it is not certain that all receivables will be recovered. There may some bad debts. There may be some entities who are going to bankrupt or who are continuously delaying the payment. It means there is a doubt that we may lose that revenue proportion. The estimates means management should estimate whether we are going to recover whole receivable or not. If there is a probability, maybe by judgment of the present condition or past experience, the management should make a provision of doubtful debts. Here it is. While we are going to sell goods on credit, then these are the certain steps I have discussed in earlier slide. Allowance for doubtful accounts, and let's see what are the extents, and we will also discuss this topic as account receivable or bad debts in our later lecture. It will be whole lecture, or it will be covered in whole lecture with some advanced accounting treatment and disclosure requirements. Allowance for doubtful accounts. One common estimate in the business is to estimate the net realizable value of account receivable. It shouldn't be overstated because we are working on you can say objective here, that is to disclose the true and fair data, and for this purpose it is really necessary to estimate whether we are going to collect all receivables in time or not. If not, means it is going to be a doubtful account, and if it is going to be a doubtful account, it should be excluded from the revenue as bad debts. bad debt expense should be debited into the profit and loss account, and an allowance for doubtful debt should be created, which will be presented in current assets in the under the heading of receivables. That will reduce the receivable amount. Simple. Since we know that some receivables never actually get collected, then we will treat like this: gross amount of receivable less means deduction after deduction, allowance for doubtful debts that we are creating, and we will present net account receivable into the balance sheet. The principle of revenue recognition. As I have already discussed another aspects of revenue, the need to recognize revenue, and matching concept, along with need to create provision for doubtful debts. Here we will discuss the revenue recognition criteria or the concept. Revenue is earned and recognized upon product delivery or service completion, and the amount of revenue can be measured reliably. This is what IS 18 says. Without regard the remaining of cash flow, the timing of cash flow, whether cash is received or will receive at the time of the transaction, at the time of delivery, or after some period. The journal entry is definitely, you will be familiar of it, will be recorded like this: if payment at the time of goods or services are provided, debit cash, credit revenue. It's very simple. And you will note here that wherever we are going to make any accounting treatment, any journal entry, we are using debits and credits. And further, if payment is not received at the time of services provided, then definitely it is a receivable account, means it is the income that has been incurred and cash will be received in future. Here it should be recognized, recorded in the period from which it relates. The entry will be debit account receivable, credit revenue. And when the payment is realized, the payment has been received, then the reversal of account, means cash account will be debited as an increase in asset. Cash is an asset, a short-term asset. Cash will be debited, and definitely account receivable is another short-term asset that is decreasing at the moment, and it will be realized and recorded into the accounts as credit. Here we go. Prudence concept. This is very interesting. You will see various accounting conventions and accounting concepts. These are related to the professional judgment, estimates, and presentation of the data. Here, prudence concept also states a very key point. The point is that the element of assets or liabilities or income or expenses should not be, neither it shouldn't be underreported, no, it should be overstated. Here we have already worked on the basis above, like bad debts, and let's see what it states. Preparation of financial statements requires to use professional judgment in adoption of accounting policies and estimates. Prudence requires that accountants should exercise a degree of caution in the adoption of policies. In above slide, we have discussed bad debts, but it may be some sort of contingent assets, contingent liabilities, and so forth. Here, prudence requires that accountants should exercise a degree of caution in adoption of policies and significant estimates such that the asset income of the entity are not overstated, whereas liabilities and expenses are not understated. Please understand it, and I will recommend you to learn all above and below concepts, conventions. These are very important tools for the accountants for preparation of financial statements. Now, we have got two more important conceptual framework here for preparation and presentation of financial accounts. Number one, that is full disclosure policy. Entities should adopt this policy because accounting should be practiced, should be based on true and fair opinion, true and fair basis. It should disclose all true and fair data. True and fair means recognized, eligible data, all those data that are well judged, well estimated, and legal. Full disclosure concepts states that a company's financial statement should report enough information for the user to make informed decisions about the company or for the company. Here you will see that when we are talking about the presentation of the financial statement, we talked about the user of the financial information. Definitely, we are preparing financial statements for the users. Who are the users? They may be the stockholders, the shareholders, the managers, directors, board of directors, auditors, and definitely parties who are interested in the investment in the company, like banks who are interested in financing of the company. They want to know the operations result of the company, the liquidity of the company, and definitely the going concern aspects of the company. Another important concept, that is going concern concept. Entities should disclose that whether they are going to be continued in their operation for future or not. This is one of the important concepts while preparing a financial statement. Let's see what going concern principle states. The going concern assumption assumes a business will continue to operate in the foreseeable future. A common time frame might be 12 months. However, one should presume the business is doing well enough to continue operations unless there is evidence of the contrary. Definitely. For example, an entity that sustains huge losses. Now it is questioning that, it is worth questioning that the entity will continue to operate in its future or not. And it can be well judged through its states of affairs, its balance sheet, whether the company have enough liquidity, whether the company have capacity to sustain such sort of losses, and they can recover from the losses or not. And finally, here are some important principles that shouldn't be ignored while preparing accounts and financial statements. These are: number one, historical cost principle. We will discuss this principle in more detail while having lecture of fixed assets or non-current assets with IAS 16, and further I will explain you here briefly that items should be recorded at their cost, at that cost that is paid against a consideration of an asset. Especially for fixed assets, it should be recorded at cost, definitely, while purchasing. Though we have revaluation methods, but revaluation is not the procedure that we use at the time when we are recording or recognizing an asset. Hence, you can say that fixed assets or non-current assets should be recorded at the price, at the cost at which it is invoiced and the consideration has been paid. Here, another aspects that some knowledgeable crowd may understand, may think. I will make it clear that for inventories are also recorded at cost, but the method of the valuation is slightly different from non-current assets. Inventories should be recorded either a lower cost, uh, either that is the market price or the purchase price. If the purchase price is lower, then it should be recorded as purchase price, should be valued on its purchase price. And if the market price is lower than the purchase price, it should be recorded, disclosed into the books of accounts at its market price. This will present true and fair view of entity. Further, this is very important principle, and when you see the business or the company law references, it will be appeared at the face of the first chapter that an entity is a different entity from its owner. The entity is identical. The business is an identical entity from its owners and managers. Here, financial statements and accounting records are distinct. Remember, different, identical from the owner and the managers of the business, and are separate entities. I think these explanations will help you a lot for your studies. I will try my best to put some more lectures briefly. Actually, these are the topics that can be, you can say, if I'm going to explain it with whole aspects of these topics, then it will take much more time. And I think for YouTube viewers, it is sometimes hard to carry on the whole lecture at once. So that is why I put it on various parts, so that you can understand it very well. And I will put some more informative and important lectures in future. If you like my channel, if you have some benefits, then please subscribe and like and share the video. Thank you very much. Meet you with another good lecture. Bye bye.